Okay, guys, welcome to our first session. For those who are doing their first year, ane, my name is Uxolile Khatebe. So please, if you just joined, okay, could you kindly mute your mic because you're going to disturb the others. Ane? Yeah. So my name is Uxolile Khatebe. For those who don't know me, I'm doing second year BCom with specialization in business and financial analytics. Ane? I did accounting with UG, and then from there I came this side. ane. So today we are going to be do, or we are going to focus on the introduction to accounting, and then we are going to look at the document called the Conceptual Framework, which is a guiding document for all the accounting that you are going to do this year and in your future years as well. So I think the first thing that we can do is to try to answer the question, Yoguti, what 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 are we really trying to do with the accounting? What is the accounting about? What objective are we trying to achieve with accounting? So I think if we can answer those questions, we can be able to move forward, and we can be able to understand like the broader picture of what we are expected to do and what we are expected to understand as future accountants, or as teachers who are going to teach accounting. So again, if you just joined, please mute your mic because you're going to disturb others. Thank you. So what resources are going to be required for you to be able to pass the module? The first thing is that you need to have 2 books. Exercise book. So you need to have a notebook where you are going to take notes classing. This is where you are going to have your notes, guys. This thing of being unorganized is not going to serve you well, especially with accounting. It needs someone. In fact, accounting is all about organizing information. So if when yourself you are not organized, it's going to be difficult for you to be able to pass the module. So you need a notebook, and you also need a practice book. So if you can buy it, require, it's fine. You can have that require as your notebook and your practice book as well. It's going to save you very well. So why do you need a notebook and this practice book? Guys, that textbook is very big. Those who are doing accounting last year, they will tell you that textbook is very big, and it's also used by second years as well. So there's a lot of information in the textbook, and most of that information, or some of that information, you don't need it for a first year. So you need to know which information you are required to know for your level, so that you can be able to apply the concepts that you are taught. So you need to take notes, my class in, and then also have a practice book as well, where you are going to practice accounting. At least do 1 question every day, and then submit that question in Blackboard. Get a memo, and then mark yourself and see where you did wrong. Accounting is all about practice, guys. If when I think that you're only going to study accounting before an exam, you are going to have a very difficult time. Not to say that you are not going to pass, but you are not going to pass the way you are supposed to pass. Deep down, you know that you do have the ability to pass accounting very well, but because maybe you are not organized, or because you are lazy, you end up settling for 50. But deep down, you know that you can do very well. So if you can organize your notes and have a book where you can practice, not this thing of practicing accounting and then the same book there's economics there, notes for economics, then there as well there's a blackboard question that you are doing for EPAS. It doesn't work like that, guys. And then, so if you can be organized, you'll be fine. I promise you. It's over grand. Then obviously you must have a calculator as well, and an open mind. An open mind is very important because especially for those who are doing accounting for the first time, and you do have the ability to pass the module, but you need to know that when you are at a disadvantage here because you are competing with people who did accounting in high school and when you didn't do it. So you can choose to either feel sorry for yourself and then not put in the work, or you can work very hard and then pass the module. You can even pass with a distinction. I had a student last year who came from a background engineering from another university. That guy passed with a distinction. He has never done accounting in his life. So it's up to you guys. And if you can put in the work and stay organized, you'll be very much fine for this module, guys. And so with that being said, let's start again. So if you have a notebook, la corner, and a pen, please take my notes. For those who were working with me from last year, you know this thing, guys. Try to take my notes as much as possible. And then if you have a question, you can unmute your mic and then ask your question. And it's very much allowed. And so what are we trying to achieve with accounting, or what are we trying to do by accounting? Why does it even exist in the first place? So accounting, guys, as I've said, is about organizing information, is about transforming information from being raw data. Is about transforming raw data, into information that can be used for decision making. And I know this is still vague, but as we go, you'll understand this. So what are we trying to do? We are trying to take now raw info. So we are trying to take raw information in the form of daily transactions that happen every day and in the business. So for those who don't have a background in accounting, you might be asking yourself, what is a transaction? A transaction is you going to Pick and Pay to buy bread. That's a transaction that has happened. A transaction is you going to the bank, for an example, to deposit money. That's a transaction. And a transaction is a business selling inventory to its customers. That's a transaction. So we are trying to take those daily transactions that happen, which are just raw data. And so we are trying to take those daily transactions that are just raw data, and we are trying to do what? We are trying to transform them, or we are processing them. So we process these transactions to what? We are trying to process them into information that is useful. So we are trying to process this raw data in the form of transactions into information that is useful to the people who provided funds to the business. So information in the form of what? Information in the form of what is called financial statements. So if you take a company, for an example, like a ShopRite, and each and every day there are transactions that are happening in ShopRite. There are people who are buying their tickets there. There are people who are buying clothes. A lot of things are happening there. So those daily transactions, we need to, because they are just raw data, we need to process that information, that raw data, into information now that can be useful to the people who are the owners of ShopRite, and the people who have invested money to ShopRite, and the people who have lent money to ShopRite. So that's the whole objective of accounting, guys. You'll see when we get to the conceptual framework, the objective of financial reporting, it's going to state thoroughly with like what is it exactly that you are trying to do. But in layman's terms, if you have never done accounting, this is just what we are trying to do. We take raw data in the form of daily transactions that happen each and every day, and we are taking that raw data and we transform, or we process that information into what? We process that raw data into information that is useful to the people who have a vested interest into the business. So the process that we use to transform raw data into information is called the accounting process. We are still going to do it later. So it's an accounting process. So it's a series of steps that this raw data has to go through before it becomes what? Before it becomes information that is useful. I hope it's making sense. So that's what we are trying to do. So maybe you're also asking yourselves, like, what are these financial statements? So in order for you to understand our financial statements, let's make this analogy. Let's say you are doing matric last year, or you are doing first year the same. So you are going to be going to school each and every day, or you were going to school each and every day, and you were writing assessments last year. In your matric, you wrote assessments, and then the marks that you got for those assessments were recorded by your teachers or by the staff members from your respective schools, and then they were taken to the department, and then they were processed there. So the end goal for you, or the end result of you going to school, writing assessments, submitting your work and everything, is that you got what at the end? You got your matric statement, okay? So that matric statement is showing marks wakho, is showing your so that matric statement is showing your results, showing your results. So that was the objective, and those results that are on your matric statement, they are important to certain individuals or to certain organizations. For an example, they are important they were important for the university to decide whether to accept you or not, for an example. So it's the same with a business. Those daily transactions that happen, we process them in order for us to produce information that is useful. You were going to school the whole year last year, for an example, whilst you were doing matric, so that at the end of the year you could receive your what? You could receive your academic statement or your matric statement. So that statement is useful to certain decision makers, such as the university, such as yourself as well, because if you received certain marks, you decide whether or not you are going to university. So that's the whole objective of what we are trying to do, accounting, of why we are trying. That's the whole objective of what we are trying to do with accounting, guys. So now that we've put that aside, let's go to the conceptual framework. So what is this conceptual framework? So there's a document in accounting called the conceptual framework. So this document is like the founding document, accounting. This is the document that guides us now or on what needs to be done. It gives us some definitions. It's like the skeleton of your accounting, is what holds the accounting together. This is where you are going to find information about objective of financial reporting. This is where you are going to find information about, which is objective of financial reporting is like objective of accounting. This is where you are going to find information about the different users of financial information. You are going to find information such as what are financial statements. This is where you are going to find information about the characteristics now of these financial statements that you are trying to prepare. This is where you are going to find information about the elements of financial statements. So because you are coming from high school, these concepts are still foreign to you. But as soon as we start explaining them, you are going to be able to understand now with what are we really trying to, or what does the conceptual framework entail. And then there's a whole lot of other information as well that is there on the conceptual framework. But it's just a document that tells us about the foundation of accounting, the important concepts that you need to be aware of as far as accounting is concerned. So we are going to start now with the objective of financial reporting. So the objective of financial reporting, you need to know it word by word, guys. Okay? So you need to know it word by word. You need to know word by word this objective of financial reporting. And I've already explained the objective of financial reporting, but I'm going to write it down for you and explain it to you again so that you understand it. Okay? Yeah. So the objective of general purpose financial reports and is to provide financial information. Please mute please mute your speaker there. Is to provide financial information about the reporting entity. This information must be that is useful to existing and potential investors, lenders, and other creditors. In making decisions about providing resources to the entity. Yes. So I'm going to try to break this thing down because I can see it's very long. But it's very important for you guys to understand. So this statement is saying that the objective, which means that the goal of general purpose financial reports, the goal of our financial statements, of which I've already explained. So the goal of our financial statements is to do what? Is to provide now financial information. Remember, I said that our objective as accountants is to what? Is to transform raw data in the form of daily transactions into information. Remember when I said that? So this thing is also agreeing to say that our goal is to provide financial information about the reporting entity. So what is the reporting entity? So the reporting entity is the business that you are preparing our financial statements for. And so for an example, if you are working for a MTN as an accountant, then you are preparing financial statements for a MTN. The reporting entity there is MTN. So you are trying to provide financial information about MTN, which is the reporting entity. How should this information be? This information needs to be useful. And it's very important. It needs to be useful. You must underline the word useful because useful means that the information should meet the fundamental and enhancing characteristics. And so if information is useful, it means that that information, it needs to faithfully represent the operations of the business. So what does faithful representation mean? It means that the information that you are trying to produce must be free from errors and omissions, which means that the report that MTN will publish to its investors or to its stakeholders, it needs to be free from errors and omissions, which means that akumelanga ibe nama mistakes, and there shouldn't be things that are left out there. And this information, it needs to be relevant. So that basically means that this information, all the important things, must be shown on these financial statements, of which is the information that we are trying to provide. So we are saying that the objective of general purpose financial reports is to provide financial information about the reporting entity, which is the business. This information, it needs to be useful. So when information is useful, it means that one, it must be faithfully represented, and then number two, it must be relevant. So relevance means that all the important information should be there on the financial statements. So who are we providing this information to? That's another question. Who are we providing this useful information to? Cancel. Okay, guys, this thing in a limit 45 minutes. So we are only left with 10 minutes. And then after 10 minutes, it's going to close. I'm going to create another Zoom meeting and then we'll continue. So this information we are providing to who? We are providing this information to existing and potential investors, lenders, and other creditors. So this is important as well, because these three parties, potential investors, lenders, and other creditors, these are what we call primary users. So these people, we call them primary users of financial information. So why specifically? Why does the conceptual framework prioritize these people specifically? Because there are different people who can use our financial statements. Trade unions can use our financial statements of a business. South African Revenue Services can use our financial statements of a business. But why does the conceptual framework specifically outlines these three parties? So there's a concept in accounting called the accounting equation, and then we are still going to do the accounting equation. So it's saying that assets are equals to equity plus the liabilities. So the accounting equation basically says that the assets that the business owns are equals to the equity. Equity is the capital, which is the money that was contributed by the owners, plus the money that was borrowed from other people. So if you take that money that was contributed by the owners and the money that was borrowed from other people, you can use that money to buy the assets that the business own. So considering this now, so the conceptual framework specifically states investors, because investors are the people who provide what? Are the people who provide equity to the business. So these people are interested in the financial statements or are interested in the financial information of the business because they've invested money there. So they want to know what's happening with their money. Were these assets even bought with their money? So that's why the conceptual framework specifically outlines to say investors are primary users. These people are important, and because they want to know what happened to the money that they invested. The lenders and the creditors are the people who have borrowed or are the people who have lent money to the business. So these are the guys who have lent money to the business, and money that was lent to the business is part of what? Is part of our liabilities. So these two guys as well, they're important because they're the ones who have borrowed the business money, or they are the ones who have lent the business money to do what? To be able to buy these assets that they own. So the conceptual framework specifically states these parties in the definition of the objective of financial reporting, because these people are the ones who have provided resources to the business in the form of funds or money. And the investors, they've provided what is called equity. Lenders and creditors, they've provided what is called liabilities to the business. And so these people, they want to know what happened to the resources that they have provided into the business, so that they can make decisions about providing resources to the entity. And if you have already invested money into a certain business, you would want to know if you should continue investing or not. If you have lent money to a particular business, and you would want to know if you should continue giving those people your funds, and are they making profit so that they can pay you back. So this is why we are doing accounting, guys. We are doing accounting to provide information that is useful about the reporting entity, which is the business that you are preparing our financial statements for. To who? And so to existing and potential investors, lenders, and other creditors. These are the people who have provided funds to the business. And so these people, they need this information to make what? To make decisions. Guys, this is as far as I can explain this thing. And I hope that you are going to be able to understand it. And once you understand it, once you can understand it, you'll be able to write it the way it is. And on a test or an exam, they want it like this, guys. So I just hope that you understand. So this is what's going to happen. I'm going to close this meeting, or I'm going to end this meeting, and then I'll send another link right now because it's only a few minutes left before this thing closes down. So it has a limit of 45 minutes. So I'll close this one, and then I'll open another one. Then you join again. And yeah. So there's a concept, guys, called primary users. Or they will ask you about who are the primary users of financial information. And then when you're answering them, you'll tell them that it's existing and potential. Who, number one, is the investors, the lenders, and other creditors. So this is the answer you give them. So if they ask you about the primary users of financial information, you'll tell them that it's the existing and potential investors, lenders, and other creditors. So why are these people? So why are these people specifically the primary users of your financial information? So these people are the primary users of financial information because they have provided funds to the business. So remember, a business needs some assets to do what? It needs some assets to be able to operate. So these assets are used to generate what? To generate a profit for the business, which is why the business starts in the first place. But for the business to be able to buy these assets, it needs funds. And those funds, they come from investors, they come from lenders, they come from other creditors. So that's where these funds are coming from. The investors, they provide equity. So equity, they provide equity in the form of what? In the form of capital. Capital is the money that is used or is the money that is invested by investors into the business. So the investors, they provide capital, which forms part of equity. And then the lenders and other creditors, they lend money. So these guys, they lend money to the business. So we call this money liabilities. So a liability is sekoloto. So when something is a liability, it means that you have an obligation to pay it back. You have the responsibility to pay it back. So if someone, or if you owe someone their money, you have an obligation or a responsibility to pay them back. So these people are the ones who provide liabilities to the business. So they borrow or they lend the business funds. And then the investors, Bona, they are the guys who have invested capital in the form of equity in the business. So these guys, they are expecting what? They're expecting a return on their investment. So if the business makes a profit, they want a share of that profit. It's called a return on the investment. So since the investors have provided equity and the lenders and other creditors have provided liabilities into the business, they would want to know the current state of the financial affairs of the business. Is the business making money or not, and all those things. So that's why these guys are the primary users of financial information. So essentially, what does this mean? It means that we are preparing the financial statements primarily for them, because they are the ones who are important, since they are the ones who have blessed the business. So let's continue again. And then the next one, we are going to talk about financial statements. Financial statements, these are the documents that form part of our financial information. So financial statements. Financial statements. So the first statement that you prepare is called the statement of profit or loss. Then secondly, there's a statement called the statement of financial position. Then third, there's a statement called the statement of changes in equity. Then number 4, you've got the statement of cash flows. Then lastly, you have what is called notes to financial statements. So the information that we are trying to provide to the primary users, which are lenders, which are existing and potential investors, lenders, and other creditors, that information we provide it in the form of financial reports. And just like now, the information about your academic performance is provided in the form of an academic statement or a metric statement, and the business does the same. So they provide a report to these people. So that report entails these 4 statements, which is the statement of profit or loss, the statement of financial position, statement of changes in equity, and the statement of cash flows. And then the notes to financial statements, these are just notes that explain the information that is on these 4 statements. So what is the statement of profit or loss? So a statement of profit or loss, it shows like the performance of the business. How did the business perform? Did we have income, or did we have income that was more than the expenses that we paid? If we have income that is more than the expenses, it means that the business generated a what? It made a profit. So if the money that came into the business was more than the money that went out, it means that the business made a profit. So the statement of financial position tells us about the performance of the business. However, if the money now that came into the business is less than the money that went out of the business, which means that the income is less than the expenses, it means that the business made a loss. So the statement of profit or loss tells us about that. And then the statement of financial position is linked. So the statement of financial position is linked to what? Is linked to the accounting equation. So the statement of financial position tells us how many assets do we have as the business, and how were these assets funded. Were they funded through both equity and liabilities? How much equity was contributed to fund these assets? How much liabilities were contributed to buy these assets? So the statement of financial position is a snapshot. That's why it's a financial position. It's a snapshot of where the business is in terms of the assets that they have. And so it's the snapshot of the position of the business financial. And then the statement of changes in equity. Remember, equity, I said that who provides equity to the business? Equity is provided by, equity is provided by investors. Remember, I said that. So the statement of changes in equity tells us now about the changes in this equity. Did the investors invest more money into the business? Did they disinvest into the business? Did they withdraw funds from the business? So the statement of changes in equity, it tells us now about the fluctuation of capital, the movement in capital during the year. And it's the easiest statement when you compare it with the others. And then the statement of cash flows, you are not going to do it this year, guys. And so don't worry about it. But the statement of cash flows, it tells us about the movements in cash, and you are only going to do it when you are doing second year. And then the notes to financial statements, as I've explained, it's just accounting notes, and that explain the information that is in the statement of profit or loss, the statement of financial position, statement of changes in equity, and the statement of cash flows. And now that you understand the type of financial information that we want to produce, the financial reports that we are expected to produce. Remember, at the beginning, I said that our goal is to transform or is to process raw data in the form of daily transactions into information that is useful. And this information comes in the form of what? In the form of financial statements. So this is the end goal. So this is where we want to get in terms of the process that we are trying. This is what we are trying to do, and in accounting, guys. And then the next one, I'm going to talk about the characteristics now of this information that we are trying to provide to existing and potential investors, lenders, and other creditors. Just like your metric statement, the people who are interested in your metric results, they need to know whether the information is true or not. They need to know whether the information is coming from a credible source or not. So you'd find that the metric statements, they have certain characteristics. You'd find that maybe, for an example, the signature of Umalusi, it needs to be there. You'd find that there's a certain design. There's a certain design in which all the statements are imprinted with. So all those things, they are the characteristics of the metric statement that is produced. And so that the people who are interested in that metric statement, and they can trust that the information that is there is coming from a reliable or a credible source. So even with the financial statements or the financial information, it has to have certain characteristics, or it has to have certain qualities. It has to have certain qualities so that the people or the primary users of this financial information can trust that this information is relevant and faithfully represents the operations of the business. And I hope that's making sense. Remember, information is to be useful. So when we say information is useful, it means that it is relevant, and it faithfully represents the financial operations of the business. And then, so we are going to talk about those characteristics now. So, characteristics of financial information. Ne? So, there's what we call primary characteristics or primary qualities. And then there's what you call enhancing the primary. Oh, sorry. Okay, it's fine. It's fine. Let's do this. Secondary characteristics. So the primary characteristics, are also called the fundamental. And then these ones are called the enhancing characteristics. These ones are called the fundamental characteristics on the conceptual framework. And then these ones are called the enhancing characteristics on the conceptual framework. So the primary characteristics, is that the information needs to be what? It needs to be relevant. So there's only two primary characteristics, and that the information needs to faithfully represent. It needs to faithfully represent the operations of the business. I've already explained this. So the fundamental characteristics are really linked to whether the information is useful or not. So we said that for the information to be useful, that information needs to be relevant, and it must faithfully represent what happened in the operations of the business during that particular financial year. So I also explained that information is relevant if it lists all the important information, or if it describes, or if it produces all the important information about the business. And I said that information, we say that information faithfully represents the operations of the business if it is free from errors and omissions. And so if information is free from errors and omissions, ama-omissions, it's when like you leave out information, and ama-errors, ama-mistakes. So if information is free from these errors and omissions, we say that it faithfully represents what happened in the business, because it entails everything or most of the things that happened in the business on that particular financial year. And then we say that information is relevant if all the material, the wording they use on the conceptual framework is material. So material means important. So we say information is relevant if it conforms with materiality, or if it describes all the important information. And then as far as the secondary characteristics are concerned, there's four. There's four secondary characteristics, or there's four enhancing characteristics that the financial information must have. So the information must be comparable, and it's called comparability as well. It must be verifiable, so you must be able to verify it. And then so when it's comparable, it means that you can compare it to another business. For an example, You can compare ama-financial statements awe-MTN versus ama-financial statements awe-Vodacom. And when you look at the financial statements of both of those companies, the information is comparable. Also, information is comparable if MTN can compare their financial results this year and last year. Verifiable means that this information can be verified, or the very same another person who is within the commercial stream, they can reach the same conclusions about the information if they were the ones who had to prepare it. And then timely or timeliness. So if the information is timely, it means that it must be reported on time. And as an investor, I'm interested in the financial statements, our MTN, this year, not 2011. What am I going to do on my financial statements with MTN among 2011? So it must be timely. So it must be reported on time, or it must be available to the decision makers on time. And then that information, it must be understandable. So it must be understandable. So people who have a background in accounting, people who have a commerce background, they have to be able to understand the information. So these are the characteristics that this financial information must have, so that it is useful to existing and potential investors, lenders, and other creditors. Yeah, so guys, this is where we are going to stop for today. It's been an hour already. So you can unmute your mics, especially if you have a question. You can unmute your mic and then ask your question. Hopefully, I'll be able to answer. Okay, guys, I guess there's no one who has a question. And then in that case, if you still want to ask, you can ask on the group. I don't have a problem. You can ask on the group. Hopefully, I'll be able to help you. But be that as it may, thank you very much, guys. I'm going to see you on the next session, which is Thursday. Thank you.